So happy new year to everyone, and I hope everyone had a good break. Welcome to the first quarterly economic update of 2023, hosted by ourselves and Alex Brandreth, Chief Investment Officer at Luna. I think it's safe to say that 2023 was a volatile year for everyone, and perhaps not what we expected at the start of 2022, with the difficulties that we've had over the previous COVID years. In 2023, we've had 3 Prime Ministers, 4 Chancellors of the Exchequers, double-digit inflation, which hopefully Alex will touch on, and we've seen that maybe that's at its peak. Spiralling interest rates, again, that have increased to 5%, which perhaps is the norm, as opposed to the low interest rates that we've had since the financial recession in 2008. Widespread workers' strikes, a war in Ukraine, and the tragic loss of Queen Elizabeth. But at times of volatility, we can't stress the importance of our clients reviewing their needs, priorities and objectives, and making sure that we review your risk and volatility to ensure that all the plans that we've put in place and the advisors are advising you on are still on track for what the original objectives were. As your plans have been taken out from medium to long term, our advice is not to react to short-term volatility, but obviously it's something that we should be aware of. In today's market and economic update, Alex will be looking at the investment market update for the year, looking at inflation expectations, the economic outlook for 2023, and what we can expect from markets over the next 12 months. Just before I pass you over to Alex, just like to run through some housekeeping. To mitigate any background noise, can we ensure that everyone is on mute, as it should be? The presentation is being recorded, and we'll get that emailed out to you, and it'll be accessed via the website. The webinar should last around 40 minutes, and for those who haven't joined in the presentation previously, there's an opportunity at the end of the presentation for a Q&A. They can be sent to us by the question and answers button at the bottom of your screen. So without further ado, I'd like to pass you over to Alex Brandreth, Chief Investment Officer from Luna, who will run through the presentation. Over to you, Alex. Thank you.
Thanks, Stuart, and happy new year, everyone. As Stuart highlighted, last year was very volatile in different asset classes. And just summarising the final quarter, it was actually a much better period for investment markets. The new Prime Minister, the new Chancellor, the complete U-turn on the mini-budget fiasco at the end of September has really stabilised markets, particularly in the UK. It feels like a long time ago, that mini-budget now, but it was only just 3 or 4 months ago. But it's amazing how quickly things can change and how political change can impact markets so quickly. So I'm going to start sharing the screen, and we'll go through the slides today. As Stuart said, please feel free to ask any questions and we'll answer them at the end. So, as Stuart's touched on, it was a very difficult year for investors. 2022, most asset classes fell in value. Quite surprisingly, as we'll highlight later, there was bigger falls within bond markets than equity markets, which you wouldn't normally expect from safe havens like government bonds to fall so much, and we'll highlight the reasons for that. The UK market was actually one of the better performing global markets. Because it was such a challenging year, and we'll touch on this later, valuations across asset classes are looking very attractive, whether that be bonds or equities. And the drivers of this market volatility has been central banks increasing interest rates to fight off this inflation that we're seeing. Politicians, as we've seen within the UK, have been having an increasing impact. Geopolitical matters, I mean, the main news of last year has to be Russia's invasion of the Ukraine. That's had a big impact on commodity markets, oil and natural gas and food prices in particular, but also there's been ongoing tensions between the US and China, which has been impacting markets as well. And within China itself, they've been having their own COVID strategy, which changed in the final quarter of last year, but that's certainly been having an impact on Chinese growth and global growth. China is the second biggest nation in the world nowadays, and if China slows, it has a big impact on global growth overall. I mean, it's amazing that I've got to 4 bullet points and we're only just talking about inflation. Inflation was clearly the big story of 2022. It's impacting us all. You know, the BBC has a dedicated cost of living crisis page nowadays because of it's impacting us so much. It's a topic that we'll touch on. It's important to see where we've been, but it's also just important to see where we're going. And we've got some kind of a guidelines of where we think inflation might go into in the future. Economic growth has, because of this inflation, has definitely slowed within the UK and Europe. Within the US, it looks likely to slow. So it's definitely having an impact within economies at the moment. And that is going to be key as we move through this year in terms of what central banks do with regards to interest rates. We've been putting interest rates up to fight inflation this year and last year, sorry. But this year, if economic growth continues to slow as it's expected to, then you really expect central bankers to be potentially changing direction. At the moment, they're talking a very hard line and saying that's not possible and they're not going to do that. But we'll wait and see what happens and how quickly inflation falls to whether they do blink and change their direction. And some positive / negative news here. The employment market has been very strong. Unemployment rate within the UK is at a 40-year low. That being said, when economic growth deteriorates, you do see companies laying off workers, sadly, and that means the unemployment rate does tend to pick up when you're in recession. And maybe I should have said it before, that it's probably likely now that the UK is already in recession. Recession is classed as 2 quarters of negative economic growth. It's very likely that we've already had 2 quarters of negative economic growth within the UK already. And sort of leading on to that, this chart here, just on the left-hand side, just shows, well, what was 2022 like in those grey bars, and what is 2023 predicted to be like from economists in that kind of purple bar. And we've got a number of different countries here. You've got the UK. So the UK actually grew quite nicely last year. It was one of the strongest global markets, global economies, growing at just over about 4.5%. But you can see that the expectation for this year is completely the other direction. And the UK is expected to be one of the weakest performing economies in 2023. That's because we've got structurally higher inflation than the US and Europe at the moment. And there's other impacts coming through within the UK. Now, Europe is a very similar picture though. What's going on within the UK is almost mirrored within Europe. And you can see economic growth was slightly weaker last year, but is expected to still be negative this year, but maybe not as negative within the UK. The US, you can see how quickly it's expected to grow. The US on average grows around 3%. So a 2% growth of last year is below trend. And the meager 0.5% or so growth that is expected this year is pretty weak as well. Japan's always slightly different. They haven't increased interest rates yet. They have made some changes to central bank policy, but you can see Japan's expected to grow similar this year as it did last year. And China's the exception, really. You can see China's the only major economy there which is expected to accelerate as we go into this year. And this is because China has been going through a period of zero COVID strategy. And we've seen that within the UK and other countries, that when you have restrictions in place, then it really impacts your economy. We saw this obviously in 2020 when COVID came around and the UK economy shrunk quite significantly in the first quarter. But then as the economy reopens, the economy bounces back and economic growth really accelerates. You have so much pent-up demand from people not being able to do what they want that when they can, the economy completely flies. And that's what's expected to happen within China this year. As well as that, one of the big laggards, drags on Chinese growth last year was the property market. So as at the end of last year, as well as changing their COVID strategy, China also introduced a number of measures to shore up the property market, which has given investors a lot of confidence as well. And Chinese property is a big contribution to their economy as well. So various good news for China coming into this year, and that was a real headwind last year. It's nice to see that change in direction as one of the key headwinds. On the right hand side here, you've got the Composite Purchasing Managers Index, What does that mean? This is a survey which goes out to businesses and says, are conditions getting better, worse, or the same? And you can see this chart goes all the way back to 2010. You've got the different 3 nations there, the US, Eurozone, and the UK in the different colours. The reason they've got kind of a dotted line on that 50 is because anything below 50 indicates contraction and anything above 50 indicates an expansion. Now, as you can see at the end of that chart, all of the lines, the US, Eurozone, and UK are below that 50 line. What does that mean? Well, the Purchasing Managers Index is actually a very good guide of what's about to happen within the economy. Economic growth, which is released quarterly, is always a bit delayed and a bit lagged. This gives you a real feel about, well, what's actually going on right now within the economy. And it's been a very good indicator in the past of future economic growth. And sadly, as I kind of touched on, that all those lines are below 50, which suggests that the economy is contracting at the moment and we are going through some recessionary conditions, which is sort of echoed on the left-hand side of this chart here in terms of economic expectations. So as we've touched on, the big story of last year was with what happened with CPI. This chart goes all the way back to 2011. And you can see that we've been in this period of inflation trending between 0 and 5% for the last 10 years or so, really. We were expecting inflation to pick up last year. It was the first full year of the economy reopening after COVID. So we're expecting that kind of demand surge that comes through after you come out of recession. Excuse me. So we were expecting inflation to maybe get back to similar levels in 2011 because of the fact that that was the last time that we came out of recession. That's kind of where inflation got to last time. So we were sort of expecting 5%, and it was sort of moving that way towards the end of 2021, as you can see here. I mean, and then you can see what turbocharged it is the invasion of Russia into the Ukraine because of the impact that's had on commodity markets. And that surge in commodity markets is fed through into, as we know, energy prices, petrol at the pump, food prices have increased significantly. It's pretty much touched everything. So inflation has really picked up. So towards the end of last year, you did see inflation start to slightly fall within the UK. You can just about see it. Inflation fell from 11.1 to 10.7% in December. So it does look like inflation has peaked. That 11.1 will probably be the high, and it does look like it's starting to change direction. And I'll touch on that on the next slide. And this is it. So importantly, this is not just a situation which is impacting the UK. Inflation being high is impacting all global nations. You've got the US in that grey bar there. You've got the Eurozone in purple, again in the UK in blue. The UK has had structurally higher inflation than the US and Eurozone. The US, interestingly, has actually fallen for the last 5 months. The next release is actually tomorrow. So if the release comes out tomorrow and it's expected to fall again, then you'll have 6 months of inflation falling within the US. So that's starting to be meaningful. And that's important because that gives the Federal Reserve some confidence that the trend is moving negatively. Now, the US is slightly different to the UK and Europe, and the main reason for that is the fact that they're energy independent. They don't have the same reliance on Russia, for example, in terms of natural gas. So the US has been able to deal with this slightly better, and that matters because the US is the biggest economy in the world, and that has an impact in terms of global growth. So roughly about a third of the earnings reported in the FTSE 100 index come from the US. So everyone thinks of the FTSE 100 as being a UK stock market, but a lot of the profits that come in are actually derived from overseas. So it's just as important what's happening in the US and China as it is with the UK economy. Now, you can see the forecast there in terms of what's expected as we move through the course of this year. And you can see that it is expected that inflation really falls away. And that's for a few reasons. I mean, there's a famous quote that the cure for high prices is high prices. And that's because people just won't go out and spend. They won't go out and buy and pay for goods which are too expensive. And it's almost voting with your feet in a way. And if that's the case, then companies, manufacturers are therefore forced to lower their prices. And that is a deflationary impact. The other reason why inflation is expected to fall is the way it's calculated, which is an annual calculation. If you go back to March of last year, the oil price got to about $140. As we sit here today, it's at 80. So that means for the oil price to get back to the same level it was a year or so, it's got to almost, well, just less than double from the levels we are today. Equally, it's fallen 40% from its highs. So the oil price falling has been significant. And that's fed through to the pump. You've started to see unleaded prices fall down significantly. Diesel is stubbornly high. The reason for that is it's actually it comes more from Russia. In the way the type of oil that comes out of Russia is more diesel orientated. So that's why the diesel prices remained high, but unleaded prices have come down. Now, so there is some positive news there with regard to inflation, and equally, if we do go into recession, or we are in recession, then that is going to have a negative impact on demand, which means that inflation will continue to fall as well. Now, it's not all good news though. Who knows what the government are going to do in April with regard to energy tariffs and energy support. Food prices are still pretty sticky at the moment, and increasing. So whilst it's good that there's a lot more positive news coming through, there are some negatives regard to inflation, and that's why at the end of this year, UK inflation is still expected to be about 4%. Now, just want to take a little zoom out and just think about inflation over the long term. One of the big drivers and one of the reasons that inflation has been low in the 2000s and 2010s was because of globalization. We were moving production, manufacturing to China and other countries, and the cost of that was significantly lower, principally because of the wages and the cost of materials out there, etc. And then we were importing it back to the UK and US and Europe, and prices were able to come down and down and down. And I saw a forecast a week or so ago that suggested that's probably taken 0.5% or to 1% off inflation over the last 20 or so years. So the fact that we are such a globalized economy has meant that inflation has been structurally lower for such a long period of time. Now, why do I mention that? I mean, that's where we've been, but what about where we're going? And there's certainly been an increase because of COVID, because of supply chain problems, that companies are doing a lot more reshoring or moving operations out of China. And that has a long-term impact in that 0.5 to 1% reduction in inflation that we've benefited from over the last 20 years might start to reverse. As well as that, trying to completely change your energy supply to be more renewable is going to have an inflationary impact as well because of the cost associated with implementing that. So the point of mentioning this is we've been in a structurally low inflation environment for 20 years. It's equally possible that in the next 5 to 10 years, we could be in a structurally higher inflationary environment. And that means that central banks have got a more important role to play. This is interest rates going all the way back to 2002 and just for the UK, but very similar picture for the Europe and for the US as well. And you can see that after the financial crisis, interest rates have been kept at very low levels for nearly 15 years. And we started last year, 2022, with interest rates at 0.25%. We ended the year with them at 3.5%. This has been one of the biggest global coordinated increase in interest rates that we've seen in a generation. And that has big consequences. And that's one of the drivers to bond markets in last year and individual sectors and economies as well. Now, what's our expectation going forward? Well, we are expecting interest rates to continue to move slightly higher, maybe to 4.5% within the UK, which suggests that a lot of the heavy lifting has been done. So the shock that it was to markets last year is less likely to be the case this year because of the magnitude of the increase. And I suppose the other side to it is, as well, is, well, what's the expectation? And the expectation for the market is that interest rates will do that. So it's not going to have the same impact on markets this year as it did last year. That being said, that's in case unless interest rates get to 6 or 7%, which we don't think is possible because of the high levels of debt that they're having in the UK, and you'd bankrupt the government, which has got 100% debt to GDP at the moment, but you'd also have a big impact to households as well. So one of the consequences of interest rates going up is we've been used to free money almost free money over the last 10 to 15 years, but suddenly that's changed. And on the left-hand side here, you can see UK mortgage rates. This goes back to the mid-90s. You've got a 2-year fixed in grey, and a purple, you've got the 5-year fixed. And you can see that this has been a benefit to the housing market within the UK, because we've been able to borrow cheaper and cheaper, which has meant we've been willing to borrow more money, which inflates asset prices and it inflates the property market. And that's this has been one of the key drivers to the property market over the last 20 or 30 or so years. That being said, the complete change by the Bank of England has led to mortgage rates increase significantly. You can see that a 2-year has gone to closer to 6%, whereas a 5-year is slightly lower at 5.5%. That's going to have a drag over the course of the next few years. As it takes a while for interest rate increases to be felt by the economy. So it's very likely that all the increases that were introduced by the Bank of England last year are going to be felt by households and the economy this year. And not to be doomsday too much, but that's at a time when energy prices and food prices have been increasing at the same time as well. So it's going to be another squeeze on the UK consumer. On the right-hand side of this chart, you can see kind of how mortgages are broken down. Back in 2016, there was roughly about 45% in floating rate. And that matters because floating rate is impacted straight away by an interest rate increase. But gradually, over the last 6 years, the amount of floating rate mortgages within the UK is reduced to around 15%. So it's only really 15% of mortgages which are being impacted straight away by this development. The next blue bar you can see is fixed 2 years or less. So again, that's an important one to think about, because that's the mortgages that are going to be rolling over, which are going to be impacted by these new rates that suddenly are going to have to be paid. So you can see that we're floating and fixed at 2 years or less. There's roughly 40% of the mortgage market which is going to be impacted over the next couple of years. So that's going to have a big impact within the economy as well, and the housing market. I mean, it's going to have a negative impact on the housing market, and you've already started to see that filter through, and house prices have started to come down from their highs. The unemployment market, the unemployment rate within the UK is very low. You can see this chart goes all the way back to 1998. We're at a 40-year low. It's ticked up slightly, but we're still at a very, very low level for unemployment, at about 3.7% at the moment. Now, unemployment is a lagging indicator, and as we go through this year and economic growth deteriorates, you would expect more redundancies, and that means the unemployment rate is likely to tick up. Maybe not to the levels that you saw in 2008, 2009, because this was a very severe recession. We're not expecting this to be a severe recession that the UK is going through right now, but unemployment can pick up, and you saw it did in COVID here. Now, at the moment, though, we are in a very tight labour market, and that means that you are starting to see wage inflation coming through. So wage inflation within the UK is running around 5%. That's still nowhere near inflation. You've got inflation running at 10%, 10.7%. You've got wage inflation at 5%. That's a big squeeze within the consumer. We're relatively feeling poorer over the last year because wages aren't keeping up with inflation. But that is also something the Bank of England will be keeping a very close eye on, because if wage inflation gets embedded, that could lead to another leg of inflation that we need to be aware of. So it's just something that we're keeping a very close eye on at the moment, because that would worry the Bank of England if this inflation that we've gone through this year becomes embedded within the system. This is my favorite chart at the moment, and it shows you how sad I am that I have a favorite chart. But it's incredibly important. And what it shows is the economy. So you can see what happens within economies. Contrary to what Gordon Brown says, there are boom and busts. You can see what happens when the economy expands, it peaks out, we go through recession, the economy troughs, we go through recovery and expansion again. We've seen this so many times over the years, and sometimes these cycles are shorter, sometimes they're longer, but we go through these cycles all the time. And then what we have on this red line is what the stock market does. And you can see the stock market is shifted slightly to the left. And that's because the stock market moves in anticipation. The stock market moves ahead of what's going on with the economy. And that's roughly by about 6 to 9 months. So why does that matter? That matters because, yes, it can feel pretty bad on the ground. It can feel pretty dark when you've got China, which has got restrictions, when you've got double-digit inflation, when you've got a war in Europe. It can feel very dark. But that being said, the market has already moved in anticipation of that and is looking at that news right now and looking to better times ahead. And we've seen this so many times over the years. If you go back to COVID, the lower the stock market in 2020 was the 23rd of March. That was also the day that Boris Johnson stood up and told us that we were going into a national lockdown. So you really wouldn't expect the low of the stock market to be the same day as Boris Johnson announced a lockdown. And that's the reason that was, though, is because as soon as lockdown was announced, well, that's the fact. Well, what's going to happen going forward? And as investors were looking forward is, well, eventually the economy is going to reopen and the market bounced back and rallied from that. So we've seen this so many times over the years, and it's interesting that the UK is probably in recession, and yet it's been a very strong start to this year, and it was a pretty strong end to last year with regards to stock markets. So that's just what's been going on in the economy. I just want to give a quick summary of what's been going on in different investment markets. And we spent a lot of time last year and this year talking about the bond market. The falls that you've seen in government bonds have been bigger than that of the stock market, which is a very rare thing to see. You can see here that gilts fell by 25% in 2022. That's one of the biggest falls in 40 or 50 years for the UK government bond market. The US, saw the biggest fall ever in the US Treasury market last year. So it's just as important to talk about what's been going on in the bond market. Everyone likes talking about the equity market, but it's really the bond market which has been driving markets last year. It's not just government bonds where you lost money, though. You would have lost money in corporate bonds, emerging market bonds, and more strategic bonds last year as well, because of the inflationary impact and the increases in interest rates. Now, as I kind of touched on, the final quarter, and this is particularly important for the UK, markets recovered significantly. So its worst point, the UK government bond market was down over 30% at one point, but rallied towards the end of the year. December was slightly weaker. And that's a function of the fact that the change in Chancellor, the change in Prime Minister, the reversal of the mini budget really gave overseas investors some confidence to return and invest within the UK, and the government bond market picked up on the back of that. What about the equity markets? And I'm going to show two charts here, and this is just looking at global equity markets. So we've got the major markets there, the S&P 500, the US stock market, the Nikkei below that, which is that red line, the FTSE 100, the UK market, Europe, NASDAQ, which is the technology market, and the Hang Seng, which is the Hong Kong stock market. And if you'd invested in these markets and taken no currency risk at all, you can see that most of the falls last year were in the US. The NASDAQ, which is the tech index that I mentioned, fell roughly by about a third last year, which is significant falls for technology. That's the big names that we know of: Facebook, Amazon, Apple, Google, Microsoft, etc. They fell significantly across the board last year. And that had a big impact on the S&P 500 overall, because they are very weighted. Those companies have high weights in that index, and that's why the S&P in dollar terms was one of the poorest markets. One of the big developments last year, as I mentioned, was China's change in COVID strategy. And China and the Hang Seng was the worst performing market until November. But when China did a complete U-turn on their COVID strategy, when they sorted the property market out, it absolutely took off. It flew. And you can see how strongly the Chinese market rebounded in the final quarter of the year from those developments. It was for a UK FTSE 100 investor, is a pretty good year. You made roughly your dividend and maybe a little bit of capital growth. The big drivers behind that were the fact that it was commodity related. A lot of the FTSE 100 is linked to oil, BP and Shell being the obvious examples there, or other commodities. So the mining companies did very well too. And finally, one of the big beneficiaries of interest rates going up is banks. Banks make more margin when interest rates go up. So interest rates going up was a positive for the FTSE as well, because we tend to have quite a lot of banks listed within the FTSE 100 index as well. Now, I said I was going to show two charts with the same markets. And the subtle difference here is this has now been converted to sterling. So when we invest in the US, when we invest in Europe, we do so when we're buying dollars. So as well as thinking about what's going on with the overall market, we also need to think about what's going to happen with sterling and what's going to happen to other currencies as well. And sterling last year was very weak. It got to a low at the end of September versus the dollar of 103, which is unheard of. We ended the year closer to $1.20 for £1, but sterling was very weak last year. And that actually has a positive on if you're buying the S&P 500, for example. So if you, as I mentioned on that previous slide, the S&P 500 was down 18% in dollar terms last year. But for a UK client, because sterling depreciated so much, it was only down around 8%. So sterling falling actually helped investors by about 10% last year. And back to the NASDAQ, so using the dollar as well, that was down by roughly a third in dollar terms. It's down by 24% when you're taking into account sterling moves as well. So sterling did have a positive impact for UK investors last year, as long as they weren't hedging their currency exposure. Now, it wasn't good news for all of the UK market. This looks at the different markets that we have within the UK. You've got the FTSE 100, the top 100 companies within the UK in that blue line, the FTSE 250 in that kind of maroony red line. Excuse me, just have a quick drink of water. Which is the next biggest 250 companies within the FTSE, within the UK market. Small cap, what that is the smaller companies, and then AIM. So AIM is a market just below small cap. And we invest in AIM for business property relief. And you can see there's a big difference between the different markets. So the FTSE 100, as we touched on, was up over 4.7% in the year. But the AIM index, which invests in some of the smallest businesses within the UK, was down by 30% during the year. That's a big difference for 1 year. And the reason for that is because, well, we've touched on the benefit to the FTSE 100 of commodity prices on the positive side, but the FTSE 250, FTSE small cap and AIM tend to have greater exposures to the UK economy. Not as much earnings within those indices are derived from overseas. So it's more a reflection of what's going on with the UK economy. And as we've already touched on, the overall UK economy has been pretty challenged last year and this year because of the inflationary impacts that we've seen come through. So that's why those indexes are falling more than the FTSE 100 index. What does that mean? So this looks at fixed income yields. So think of this as almost like a bank account. These are looking at different bond markets and the return that you receive. We've got 5 different types of bonds here. So you've got government bonds here. You've got investment grade bonds here, which is corporate bonds. So borrowing money from Tesco's, for example, or Tesco's borrowing money off us. Higher yield bonds. So they're companies that's a slightly higher risk. They've got maybe more debt. And emerging market bonds. And let's just start with, say, the UK. So this is a UK 10-year bond. So at the start of last year, this kind of diamond here, you were getting a return of 1%. That means you could lend the UK government money for 10 years and you would receive 1%. Not very attractive when inflation was expected to accelerate. But because of the falls that you've seen in bond markets, that return is now significantly more attractive and is closer to 4%. So what does that mean? It means that a year ago, we could lend the UK government money and get a return of 1%. But because the investment markets have fallen so much, we can now get a 4% return. And if we're looking forward for 10 years, then a 4% return is significantly more attractive than a 1% return was getting you a year or so ago. So that means that bonds are now more attractive. And you can see that the bars, which is where yields ended at the end of the year, are all above the diamonds. So that means that the returns available on corporate bonds, government bonds, emerging market bonds on the whole are now more attractive this year than they were last year. And that's important because when we're managing money, we're not overly focused about what's happened. We're thinking about what's going to come in the future and the returns that we can generate. So this is important because we were actually adding quite a lot of bond exposure towards the end of last year because for the first time in 15 years or so, we were getting an attractive return on a government bond. When we started Luna back in 2020, that was clearly when COVID was rampant, interest rates were on the floor, you had quantitative easing at the time, and you were getting a 0.5% return on UK government bonds. Now, after we take into account our fees, after we take into account inflation, we couldn't see how we could deliver a positive return for clients by holding them. But with a 4% return, there's definitely a picture that can be painted which suggests that we can deliver positive returns from bonds going forward. This is now focused on the equity market and again is looking forward to what to expect. On the left-hand side, you can see earnings. So how much profit is going to be coming into UK business, different stock markets, sorry. You can see 2023 in those grey bars and 2024 in the green bars. And I suppose the good news is that they're all above zero, which means that it's expected that earnings will increase this year and next year. You can see that China is expected to bounce back very strongly, and as is emerging markets. But it's a pretty strong picture across the globe. The UK is the only major market there where it's only expected to grow by a little bit this year, but it's expected to bounce back next year. So it's a positive picture in terms of the expectations for earnings in the future. And on the right-hand chart, you can see, well, how expensive or how cheap are different markets. This looks at the PE ratio, which is the price to earnings ratio. Basically, what that means, if you get up to a level of 40 up here, things are quite expensive. If you get down to 5 to 10, then the market looks pretty cheap. The grey bar is the range since 1990. The green line here is the average, and then the blue triangle highlights where we are currently. Now, why does this matter? Because I suppose value is ultimately what you pay for something. We want to be buying cheap, good quality companies. And at the moment, despite the fact that the FTSE 100 was the best performing global stock market last year, you can still see that the UK is the cheapest global stock market with the PE around 10, which is at the lower end of the range since the 1990s. So it suggests that you're almost getting a bargain by buying the UK. Now, valuations can get cheaper, they can get more expensive, but they tend to be a very good guide to market returns over 5 to 10 years. And that's really the longer term picture that we're focusing in on when we're investing. So the UK, China, emerging markets looks very cheap. The US is quite interesting though. I mean, I mentioned that the S&P 500 fell quite significantly last year in both dollar terms and in sterling terms, but you can see it's only fallen back down to average levels really. So it's not a bargain compared to the UK, and that's principally because those tech companies still have such large weightings, and despite the fact that they have fallen, the valuations on those businesses are still pretty high. Now, this chart just looks at, well, what happens when stock markets fall by 25%? What happens over the next 12 months after that happens? And you can see here there's been 1, 2, 3, 4, 5, 6, 7, 8 instances where the S&P 500 has fallen by 25%. So what happened 12 months after that? Well, the good news is 6 out of 8, the market delivered a positive return, the strongest being after COVID, and that kind of bounce that we saw after COVID, which is led by the technology shares, was a very strong return, which is that right-hand bar. It's not always good news. On the left-hand side, you can see what was happening after the tech bubble burst in 2001. The market continued to fall and fell by roughly 18% in the following 12 months. But on average, after you have such a big fall, and as we touched on in the previous slide, markets are now attractive. Longer term investors to come in and start to buy and think there's attractive opportunities, and that has led to markets bouncing back. So I just wanted to highlight this year could be challenging, the fact that we're in recession, the economic growth is deteriorating, but the most important chart I highlighted earlier was the fact that the stock market anticipates that. The stock market moves ahead of what's going on in the economy, and you can still deliver positive returns in that environment, and you can still deliver positive returns even after you've had such significant falls. So just to summarize, inflation has likely peaked. It's fallen for 5 months already in the US. It's expected to fall again tomorrow. The UK is probably peaked at 11.1% and has already started to fall as well. And for the reasons we mentioned, the fact that the oil price has fallen significantly, the fact that other commodity prices have fallen significantly, will mean that inflation continues to fall as we move through the course of this year. Interest rates are likely to increase over maybe the first quarter this year. We'll probably get to 4 to 4.5% in the UK, but it's not going to be the same level that we saw in 2022, where interest rates were increased significantly. And that's important because that was the key driver to markets of last year. As we've touched on, economic growth has started to deteriorate already. We're probably in recession within the UK in the final 2 quarters being negative. It's not just the UK though, it's possible that's going to spread throughout Europe because that's very similar, the impact going through there. It's not totally certain at the moment what the impact will be on the US, but the US is seeing inflation fall very quickly, as I mentioned. So it's possible the US does avoid a recession this year. Excuse me. Unemployment is at a 40-year low, which is clearly very positive, but is expected to pick up for the reasons that we mentioned. The fact that companies will lay off workers, sadly, as we go into recession, is certainly going to have an impact this year. That shouldn't worry from an economic perspective. That does happen very regularly, and it shouldn't really have an impact on markets because markets see that as a lagging indicator. And on a positive side, the 2 big headwinds that we had last year were inflation and China, or 2 of the 3. China is reopening. They've lifted COVID restrictions. I mean, clearly that's led to an increase in cases, but that's not worrying the market at the moment. That China is expected to accelerate its growth this year because of the fact that it's reopening. That will have a very big impact on global markets and global supply chains as well. As well as that, the other big headwind, as I mentioned, for China was its property market last year. And as well as changing their COVID strategy, they've also changed the property market support as well. So that should again have another big positive. And that's why the Hang Seng performed so strongly in the last 2 months of the year, because it was a positive development. The market reacted significantly to that. It's not all doom and gloom. Valuations now are very attractive across different asset classes. As I mentioned, we can now buy bonds at a 4% return. A year ago, you get a 1% return. So looking forward, the returns from here are more attractive for investors in bonds. And as I highlighted in the equity market as well, there's certainly some opportunities. The UK, despite being one of the best performing stock markets, is still incredibly cheap. And there's some good quality businesses in the UK that aren't necessarily exposed to what's going on within the UK economy. So there's definitely opportunities out there for investment markets, and you just have to remember the performance of the FTSE 250 or the AIM index, which fell significantly, to say, well, that share prices have moved significantly lower over the course of last year, and markets are very cyclical. They can bounce back very quickly, and sometimes it's very difficult to see the catalyst for that, particularly, as I said, when things feel so dark with regard to inflation. But there are starting to see things starting to change direction, with China inflation being the key ones of that. And the most important point, please remember my sad favorite chart: stock markets move ahead of the economy. It's not what's happening now and on the ground that matters, it's what's happening in 6 to 9 months' time. So where's inflation going to be in 9 months' time? Where's the economy going to be in 9 months' time? It's very possible that the economy could be out of recession in 9 months' time, that inflation is on its way down. So investing in this environment might not be a bad strategy. Thank you very much. I'm going to stop sharing the slides now, and we look like we've had a few questions, Stuart, so I'll hand over to you. And equally, if anyone does have any questions that they want to add, please feel free to put them in the chat box now as well.
Yes, thanks, Alex. Very informative. We've got a couple of questions here. The first one is, we've had a full generation that only know low inflation, low returns, low interest rates, and people perceive that to be the norm. I think actually that's probably not the norm. And going forward, interest rates should be between 4–6% return, and that is usually the norm. But since 2008, obviously it hasn't been. Are we looking in the medium to long term for us to reverting back to a little bit higher inflation, higher returns that people have been getting in the market, and slightly higher interest rates? Should we expect that?
Yeah, absolutely. I mean, I touched on the reason why inflation has been kept low, which meant that central banks couldn't keep interest rates low, was globalization. Globalization really reduced inflation over the last 20 or 30 years. And so that gave central banks the flexibility to keep interest rates low. And whenever there was a crisis, it meant that they had the ability to cut interest rates very quickly to stimulate the economy. It's a bit difficult now because you've got high inflation and economic growth deteriorating. So the central banks feel like they're handcuffed a little bit, and that's why they're touching and speaking a very hard line on inflation. Now, if globalization does go into reverse, and who knows, it looks like that's the trajectory at the moment, then you would expect slightly higher inflation, which means that you need to have slightly higher interest rates in that environment. You can't keep interest rates at the low levels and keep money free, or almost free. So I would probably say that interest rates, I don't think 6% is the top of the range. I think that's too high. We are very indebted now after COVID, after the financial crisis. We've been used to borrowing money at very cheap levels, which means that we've probably, as a global and world, have taken out too much leverage, and that needs to reduce. So, but you can't have high interest rates if you've got a highly levered economy as well. So I don't think 6% is the top. 4.5% maybe in the UK. They're talking about 5% in the US has been the top of where interest rates go to. So I'd probably say a range of maybe 2 to 4.5 in the UK is the environment that we're going to go into over the next 10 to 15 years, maybe even lower if you get the global economy or the UK economy really struggling. So the Bank of England would look to move to support it. So I suppose in a weird way, we're going into this higher inflation. We're probably going to see more inflation volatility as well. So periods where inflation is higher then low again, just because of the way that it's calculated. So again, that has an impact on markets as well. So that's just something that we're very mindful of and is key going forward in portfolios.
Okay, good, thanks. I think you've answered this question already, however, I'll throw it out there. What is the impact of China abandoning its zero COVID policy? And I think you've answered that with regards to the opening up of the markets, and in the short term, it may have an impact, but it will be positive in the long term.
I mean, you've answered it for me, Stuart. There you go. You've been listening.
Very good at what I do.
Yeah. So no, I mean, you've seen it so many times when economies have restrictions, they slow. When economies lift restrictions, they accelerate very quickly because you've got that pent up demand. It's like a coiled spring. It's being suppressed, and then boom, the economy expands. And that's very much what's happening within China at the moment. And that has an impact on the markets. And the market gets excited when economic activity is accelerating. And we saw this probably most famously within the UK and US when the vaccine was announced in November 2020. That gave you the light at the end of the tunnel, restrictions being eased, and the market bounced very strongly on that.
And that bounce back happens very quickly, Alex, doesn't it?
Yeah.
So, I mean, we always talk about time in the market and timing of the market. We're all about time in the market with our clients. And it's because of those missed days that in the recovery periods, if you do miss those good days, then the catch up can be exponential.
Yeah, absolutely. That. I mean, people talk about volatility with markets, but volatility in markets happens both ways. And markets can fall, but they can also bounce very strongly as well. And China in the Hang Seng index that I showed there is a perfect highlight of just how quickly things can change. Now, if you go back to September, it was all doom and gloom for China. Fast forward 3 months, and it's bounced by 20 or 30%, which is a significant increase in such a short period of time. And that's just because sometimes you don't see what the change is going to be. No one was expecting China to change their COVID strategy at the end of September. Fast forward to the end of December, it's been announced, and the market's up. So, that's why we don't get too down and out when markets are weak, because things can change very quickly. Sometimes you just don't know what it's going to be, but it can change, and that can have a big impact. And as you mentioned, markets over a very long time period tend to increase in value, whether that be equity markets or bonds. You tend to make money. So if you're just thinking that from a longer term perspective, then you should remain invested. And those bounces, when they do come, are very strong. And if you miss out on them, and no one can market time, if anyone can market time, they'll be sat on a beach in Barbados or somewhere like that. And I can't market time, and I'm not going to pretend that I can. So if you do miss on those very strong days, and it has a big impact on your overall long-term returns. And there's a great chart which we'll maybe show in the next quarterly webinar, which highlights exactly what you said there, Stuart.
Okay, good, thanks. And just following on from that, another question that's coming in on markets and how to invest. Presumably then, the UK tracker equities are strong buys for the next 12 to 18 months.
Well, the UK market looks cheaper. So 12 to 18 months is slightly shorter time period. So if you're thinking valuations are normally good for 5 to 10 years, so that's suggesting that they'll be good for 5 to 10. Who knows? I mean, you can have events anytime which can impact the market. We've seen so many events over the course of my career, tech bubbles or COVID or inflation or interest rates or financial crisis, etc. You can always have an event. And I don't know if we're going to have an event over the next 18 months. Russia invading Ukraine is another one. So that could be the only negative in terms of market. But taking a longer term view, I definitely think that it could be invest.
Could you argue, sorry, Alex, could you argue that with UK equity trackers, particularly the FTSE, being at a high at 7.7 at the back end of last week, you perhaps missed the boat on that one? You should have been in there last 12 months ago.
Maybe not though. I mean, you'd expect markets to hit fresh highs every year because earnings increase and you have inflation's coming through. Stock market's actually a good way to invest to pass on inflation. And a lot of the companies that have been reporting this year have been highlighting the fact that they have been able to pass on the high levels of inflation and cost increases. So you would expect the market to hit fresh highs not every year, but over a very long time period. So that shouldn't be an exception. The only caveat I was going to make was the fact that if you go back and look at what happened to the AIM market, you look at what happened to the FTSE 250, those valuations are also very cheap at the moment, probably more attractive. Yes, we buy passive funds because they're lower cost, but we also buy active managers and investment trusts within the equity allocations that we have. And maybe because the top 30 within the FTSE 100 has done very well. So that's oil and banks and basic materials. but the bottom 70, the FTSE 100, hasn't done very well. So you look at ITV share price is down by, I don't know, about a third or something last year. So there are opportunities. They just might not be in the top 30 companies. So at the moment, because of that, I think maybe it'd be starting to move towards an active manager and maybe having a bit more in mid and small cap as the economy recovers and accelerates, tends to be a better way to be invested. So that's just something to be mindful of as well.
Good. Thank you. Well, that's all. Oh, that was all the questions and answers, but there's a late one that's come in. At what stage do you expect the markets will start factoring in expectations around possible outcomes of the next UK general election?
Oh, that's a good question. I think the market that will be most impacted by the general election will be the bond market, in terms of what the policies are in terms of how much is going to be borrowed or paid back. So the bond market will be key. Sterling's the other one. I mean, the bond market and sterling were really impacted by the mini budget, so they tend to be more impacted. I don't think the stock market will be particularly impacted, to be honest. There might be individual sectors that were impacted if they, that one of the parties come out with a particular strategy to reduce the profits in one sector, for example. That could have a big impact. So where are we? So about just under 2 years or so away now, aren't we, from the next general election? I mean, I don't think that's a situation to be thinking about this year. It's something definitely to be thinking about next year. But we really need to wait and see about what the stated policies are and the direction of travel from both parties. And we haven't got that yet. So, but whoever comes into power then or stays in power, they've got a very difficult job considering where UK finances are and where the UK economy is. So I don't know. Let's wait and see, and let's think about that one maybe next year, Stuart.
Okay, good. Well, again, that's all the questions and answers. So, Alex, thank you for that. It's possibly a good segue into how we look after our clients' money in terms, as I mentioned before, it's timing the market, not timing of the market. We look at a well-diversified portfolio, so it's not just the FTSE or the NASDAQ, and it's not just equities, it's bonds and property, etc. And when one does well, the other potential asset classes aren't doing as good as what others may be. So having that well-diversified portfolio and constantly rebalancing is where we look to invest our clients' money. And hopefully that will reduce short-term volatility and increase long-term returns. So I'd like to thank you all for your time today and dialing in, and Alex for presenting. The next quarterly investment seminar will be on the 19th of April. We hope you can join us. If there's anything that you'd like to discuss further with your financial advisor or Pareto, as always, feel free to contact myself or go direct to your advisor. We hope everyone has a great start to 2023, and we look forward to speaking to you over the next few months. Thank you again for your time, and speak soon.
Thank you.